govern money laundering? Who needs to be vigilant? And when should you suspect money laundering? So money laundering is a way of swapping dirty, that's criminally obtained money, or assets, into clean legal money or assets. This is often covertly done through firms like your own. The idea is to hide traces of where the money came from and who it's owned by, without the owner losing control of it. There are 3 stages of money laundering. Placement. Cash is transferred from an illegal source into legitimate assets. Layering. Money is moved around to disguise its origin, making the trail difficult to follow. And integration. Assets become part of the legitimate economy through a series of clean transactions. So, now we've got a little poll for you guys. How much money are we actually talking about here? How much money do you think was laundered in the UK in 2013?
Okay, Ellie, well, we've prepared a poll here, so I'm going to launch this, and then you guys in the audience should be able to vote on what you believe to be the right answer as how much money was laundered.
Just talking about money laundering, so just that activity. Is it less than 20 billion, or is it more than 20 billion? That seems like a lot of cash.
That's a lot of money. I guess that's quite a bit, £3 or £4 per person in the UK, I guess, perhaps a little bit more than that, which is, I don't know how criminal you get. That's a lot of money, isn't it? I'm going to go less. I can't believe it's more than that.
I reckon less as well. This is a new course. I'm not that familiar.
So we've got, most people have voted now, so we're going to close that poll and we'll see the results. So let's have a look. And 80% of you thought that it was more than 20 billion. So Ellie, do you want to reveal the answer?
We're going to go with the majority then.
I reckon so.
That's right. Well done, guys. It's estimated that between 23 billion and 57 billion was laundered in 2013, a wide range. It's difficult to gauge how much laundering goes undetected, I suppose. Those sneaky criminals. So, now we're going to talk about the Money Laundering Regulations 2007. They outline the steps that firms and individuals must take to prevent money laundering. They also enforce penalties for those that fail to comply. The regulations stress the need to conduct risk assessments, perform customer due diligence and identify beneficial owners, monitor the client relationship and ensure compliance with anti-money laundering procedures. All employees working in the regulated sector need to be vigilant for signs of money laundering. This includes financial and credit institutions, legal firms, accountancy firms, tax advisors, casinos, and estate agents. Some working outside the regulated sectors need also to be vigilant, such as cash businesses, so those that accept more than 15,000 euros, such as auctioneers. And insurers and mortgage brokers, they must have controls in place to prevent financial crime. That's quite interesting. I don't know if any of you guys listening are part of those sectors. So, when should you suspect money laundering? Common signs of money laundering include cash. Your firm should have a clear policy on cash payments and make it clear to customers when an electronic transfer is expected. Clients may attempt to circumvent your rules by paying cash into your bank account. If this is the case, consider whether there's a risk that money laundering has taken place. You've also got to look for unusual transactions, so using a personal account for business, uncharacteristic patterns of transactions or large transactions, or ones that serve no apparent economic purpose, ones that might involve higher risk locations or higher risk individuals. Look out also for cancellations. So they may pay for goods and services and then cancel to receive a refund from the legitimate company. That is really sneaky. Anti-money laundering standards vary globally, so terrorism and high levels of certain crimes could raise the risk of money being laundered. So, a case study, front companies. It's possible to conceal the ownership of a company in the UK, making it an attractive place to launder money. In one scheme, around 12.5 billion belonging to major criminals and corrupt officials in Russia was laundered through British companies over 4 years. The Russian criminals set up 2 companies in the UK. One company loaned money to another, using Russian companies and a Moldovan citizen as guarantors. The debtor company refused to pay, so the lender company sued the debtor company in sham litigation before a Moldovan court. The court ordered the debtor company to pay usually 100 million to 800 million. The debtor company would pay the sum to an account in Latvia as a request of the lender company. As the money was now associated with a court order, it seemed to have a clean origin and could be banked and spent safely. That is ridiculously clever. So look out for that, guys. So we've got another little quiz for you here. What are the 3 stages of money laundering? Is it placement, leveling, integration, placement, layering, integration, layering, and then withdrawal? What do you reckon?
Bit of a tongue twister there, really, I felt.
I'm not
Well
sure
done.
I said that properly. So placement, leveling, integration, placement, layering, integration, layering, and withdrawal.
Well, I believe it's option number 2 from what we've covered in the course so far. And we've got a good level of people who voted already. I think that's about all we can expect. Let's close the poll. And what did you think, Ellie?
I think 3. You integration, then you hide it with the good clean business, and then you take out the clean money? I'm not sure.
Let's have a look at what everybody else thought. So 60% went for my option, and 40% went for yours. So I guess.
All right, we'll go with the middle one then.
Okay.
Oh, guys, I was wrong. That's right. Well done, you 60%. The 3 stages of money laundering are placement, layering, and integration. So, in summary of that first section, anti-money laundering measures exist for a good reason, to make the UK a tough place for criminals and terrorists to operate. So we're now going to crack on to the next section, which is customer due diligence. We're just going to go through all of these sections here. So, how common is identity fraud? Businesses must carry out customer due diligence to ensure potential clients are using their real identity. How many cases of identity fraud do you think were detected in 2014 in the UK? We open that up. Is it less than 100,000 or more than 100,000? I reckon more.
I think it's got to be, partly because of my experience in polls is always go for the top answer. Is all I'm going to go with.
Say your experience in identity fraud. Yeah, I reckon I'm learning already from this course that there are a lot of sneaky people out there.
Okay, let's have a look. So this is what the audience thought is 100% more than 100,000. So following our lead there.
So let's find out. Oh yeah, that's right. Crikey. Look at that. Many of these cases will have been criminals applying for bank accounts and financial services in order to launder money. Criminals launder 10 million in funds every day through identity fraud. Crikey. There we go. So what's customer due diligence? It ensures prospective clients are who they say they are associated with legitimate businesses, have income from an expected source, and represent businesses with a legitimate owner. So what are your obligations? There are no exemptions. Your firm must keep customer information up to date, apply greater vigilance where there's a higher risk of money laundering, accommodate those who cannot provide common forms of identification, enfranchise the financially and socially excluded. Your firm must not do business with sanctioned individuals and organisations, conduct business without adequate evidence of identity. So have a think about your firm's policies and procedures. Are you guys covering all this at the moment? Enhanced due diligence. Right. So higher risk situations are going to need enhanced due diligence. This should give you a greater understanding of the customer than the normal customer due diligence procedures. It should make you more certain that your customer is who they claim to be and that their business is legitimate. It is proportionate to the level of risk involved. So, high-risk customers. Customers in high-risk countries or business sectors might warrant this. The same is true for customers that operate in countries where terrorists are active. Beneficial ownership. Firms with unnecessarily complex or opaque beneficial ownership structures require this EDD. Politically exposed persons, anyone with a prominent function in a foreign state, EU institution or international body, and their immediate family members and close associates. Non-face-to-face. You must conduct EDD if the customer is not physically present at the time of their identification. For example, because their business is initiated on the internet or by phone. That makes sense. The following transactions necessitate EDD. Unusual transactions, those lacking in obvious economic purpose, complex transactions, large transactions, and transactions that have a degree of anonymity. Anonymity? I can never say that word. Damn, I should have practiced. Okay, so the EDD is about establishing the level of risk in a relationship and enacting safeguards. Where the level of risk is high, you should seek guidance from your money laundering reporting officer. So examples of this enhanced due diligence include learning more about the customer or the beneficial owner's business, verifying the customer's identity, understanding the customer's reputation and role in public life, ascertaining the integrity and risk of a company's directors and beneficial owners, establishing how the customer acquired their wealth and that funds are being used from a legitimate source. So, beneficial ownership. Let's find out more about this. The 25% rule. An appropriate measure of ownership should be decided relevant to the level of risk involved. For example, a person holding directly or indirectly more than 25% of the shares or voting rights of a company can be said to be a beneficial owner of that company. The 25% rule is a recommendation made by the Financial Action Task Force to be modified in accordance with the risk. Appointing directors. An individual with the power to appoint or remove a majority of the board of directors has beneficial ownership of that company. And what's the problem with it? Well, criminals can use that to obscure the illegal source of their money and hide who really controls these assets. So the following information is needed to identify a company: name, full address, date of birth, occupation, nationality. It's not intended to disenfranchise those who can't provide normal identification for genuine reasons, and your firm should have solid procedures for dealing with customers who are unable to provide this information. Verification. You must verify they are who they say they are. Check that companies are in fact real businesses conducting trade and not fronts established to protect their owners. It's important. I like this bit. I'm really proud of this course. Shady Jake's Auto. You are approached by Shady Jake's Auto Repairs. The nature of the proposed business relationship seems legitimate, but you find it difficult to ascertain who owns the company. May take time, but you've got no choice but to get to the bottom of this. It seems an unnamed party has ultimate control of the business through a beneficial ownership arrangement. This convoluted structure does not seem appropriate to the business profile. Its purpose is to conceal the true owner. Further investigation reveals that the beneficial owner is not named Jake, but he is Shady. Mr. Big is a convicted fraudster with disreputable connections. You contact your money laundering reporting officer for guidance. There we go. Look at him being all shady there. The nature of the relationship. So once you know who your customer is, you need to be clear about the nature of their business, especially the purpose and intended nature of their relationship with you. There must be a clear, documented understanding of the client relationship. And if that deviates from the patterns you've established, you need to take a closer look at their activities and update your documentation. We've got another Penny Pusher's laundrette here. Mr. Penny Pusher is the owner of a UK laundrette. The source of his wealth is documented as cash transactions. You're alerted when his business makes a series of sizable transactions across EU borders. On closer inspection, these transactions do not fit the profile of Mr. Penny Pusher's business, so you contact your money laundering reporting officer who decides to file a suspicious activity report. So, customer due diligence. Another little quiz for you. Your customer checks should be risk sensitive or the same for everyone.
Well, Ellie, I guess it would be nice to do as thorough a process on everybody who walks through the door or however they're transacting with a company, but I guess it kind of needs to be risk sensitive, I would have thought, because it's dependent on the scenario. And looking at the enhanced due diligence, whatever that acronym stood for.
It's just enhanced due diligence.
Enhanced due diligence, there it is for double D, yeah. Then I think that's probably, it's going to have to be risk sensitive, I would have thought.
And you have to make sure, but do you make sure it's the same for everyone, because all your policies and procedures have got to be documented? I don't know. I'm not sure on this one.
Okay, well, let's have a look what the audience thought. So 64% went with risk sensitive and 36% the same for everybody. So I guess let's have a look at what the real answer is. We'll go for risk sensitive.
Oh, that's right. Your approach to customer due diligence should take into account the level of risk involved with the client relationship. There you go. And then there's a summary about it. If you have any concerns or doubts, always consult your money laundering reporting officer. Ongoing monitoring. Here we go. This is going to cover record keeping, risk-sensitive monitoring, sources of wealth and funds, enhanced ongoing monitoring, poor monitoring and warning signs. So this is some information about record keeping. You must keep customer records for 5 years after the relationship of the customer's ended. Here's another scenario about cooking the books. D. Jones was involved in money laundering for a high-profile crime family, but it wasn't always this way. In the beginning, his restaurant was a thriving business. After the recession, times got tough for D. Jones. He stopped cooking gourmet meals and started cooking the books. Instead of washing the dishes, he washed dirty money. In return, he got protection and a small cut. Unfortunately, you hadn't documented the nature of his business, so when he started moving large sums of money to unusual places, no alarm was raised. When the money laundering was exposed, D. Jones took the fall, but so did your firm, fined £300,000 for poor record keeping. The media fallout was particularly rough. Just desserts. There you go. Risk-sensitive monitoring, so that's going back to what we learned earlier. That must be your approach to monitoring customer transactions. Sources of wealth and funds. So distinguish between the source of customers' wealth and the source of their funds. Enhanced ongoing monitoring. So key AML staff have access to information about higher risk customers. Alert systems have a lower threshold when monitoring higher risk customers, and a clear, consistent rationale informs decisions to keep or terminate relationships with higher risk clients. We've got another scenario here about the burden of office and a Philip A. coin. I'm just going to skip that one. So the warning signs. Warning signs of poor customer monitoring. Treating customer reviews as a formality. Duplicating outdated information. Poor communication. Disregarding AML reports. Business concerns driving decisions about whether a firm should exit. Account managers not being challenged and not following up. So these are things you've got to make your staff aware of. We've got another scenario here. F. Rod, owner of a UK car wash. I'm going to carry on to the quiz. How many years should you keep records for after the end of a customer relationship? Should we offer that out?
Yeah, there we are.
Should those files be destroyed at the end of a client relationship? Is it 3 years or is it 5 years?
What do you think, Ellie?
I think it's 5 years.
Yeah, well, I guess you wouldn't want to destroy them as soon as the client relationship ended, because you've got, I assume, a duty to keep those records for a period of time. Yeah, let's go with 5 years. What's everyone else thought? So, well, there we go. It's quite clear. 87% all think it's 5 years. So let's see what the real answer is. See if we're all right.
That's right. Well done, guys. And then a summary about this section. We're going to go on to reporting suspicious activity. The Money Laundering Reporting Officer, we've already heard about him. You must nominate a Money Laundering Reporting Officer. The Money Laundering Reporting Officer must consider whether a suspicious activity report is needed and submit a report if required. This can be done through the National Crime Agency website. So, how many suspicious activity reports do you think were made in the UK between 2013 and 2014?
Oh, Ellie, that's a tricky one. We could go for the shock and awe statistic of more than 300,000, which is could well be, given the what we've learned from the course so far, is it's quite widespread.
Right. So you reckon we're going with that?
I reckon so. Let's see what everybody else has thought.
Oh, real mix.
Yeah. But we've gone 50% at the more than 300,000 mark, so
Right.
let's see where we get to.
Oh, that's right. The total number of SARs was 354,186. Of those, 82% came from banks. So, if you guys are from banks, perhaps this is the course for you. Let's go on. The Proceeds of Crime Act 2002 enables prosecutors to seize criminal assets after a conviction. More than 746 million has been recovered since 2010. It also makes it an offence to inform a criminal they're being investigated. It's known as tipping off. Before exiting a client relationship or withholding services, consult your money laundering reporting officer. The National Crime Agency may prefer to collect evidence without the criminal being aware. So, tipping off, it's an offence to disclose that a report has been made to the police, HMRC or the NCA, or that an investigation into allegations of money laundering is being carried out or contemplated or completed. So here we've got the money mule. When your customer A Parts receives a series of transfers from a known fraudster, you suspect he may be a money mule. This money is transferred into another account. You cross-check the suspicious accounts with data on known fraudsters provided by the CIFAS. A red flag appears further down the chain of transactions, so you notify your money laundering reporting officer. An ensuing investigation breaks up a crime group who were laundering the proceeds of human trafficking and firearms smuggling. Aputz claimed he was duped by a work-from-home scam that abused his bank account. In any case, he was sentenced to 2 years in prison. So here we go, we've got another quiz, spotting money laundering. Your customer, CS Rouge, has taken out an expensive life insurance policy. The policy's got a 30-day cancellation period during which the customer can claim a full refund. Your customer cancels the policy and receives a refund paid directly into their bank account. Is this a money laundering technique? Is that no, definitely not, yes, without a doubt, or possibly, maybe?
Well, I would have thought, and by the way, this is one of my favourite names in the course, SC Rouge. I thought that was particularly good. I've got a feeling he could be up to mischief, but it's not necessarily a certainty, I would have thought. What do you think, Ellie?
I don't know, would insurance companies have checked? Like, can you do checked? Is that part of due diligence? So, I'm not sure. So possibly, maybe?
Okay. Let's see what the audience thought.
Most thought possibly. So let's give it a go. Yeah, that's right. So there may be a legitimate reason for the refund, but this process can be used for money laundering. If the original funds were illicit, they've now been placed within the system by a reputable company and are ready for further integration. Crikey, life insurance, eh? So then there's a summary of what to do. It seems like if in doubt, just report it to your money laundering reporting officer. Don't leave it open to interpretation. So now we're going to go on to compliance and enforcement. The supervisory bodies, there are a number. Here they all are. Customers under sanctions. Your accountability. So what are the penalties? A penalty for withholding information under the Proceeds of Crime Act is a prison term of up to 5 years and or a fine. And what are the defences? You might have a defence from prosecution if you've not been trained in AML practices. Your firm has a duty to provide AML training and refreshers at appropriate intervals. Once trained, you'll be legally liable if you ignore or miss clear signs of money laundering. Another line of defence is available if you can prove it wasn't possible for you to make a disclosure sooner. So something to be aware of. There's some information about liaising with law enforcement. Your nominated officer must keep a clear record, and some more information there when you're submitting a report to the National Crime Agency. Case studies about violating sanctions can have serious repercussions for you and your firm. A bank was fined $100 million for conducting business in Iran, Burma and Sudan. A prominent UK bank has been fined $1.9 billion for deliberately removing customer information and allowing transactions involving Libya, Sudan and Iran. And a bank was fined $8.9 billion for concealing business with Sudan, Iran and Cuba. You can view a consolidated list of the HM Treasury sanctions online. So crikey, that is big money, isn't it? So here we go. One more quiz. You're alerted by an unusual transaction made by one of your high-risk clients. The person is a politically exposed person. What should you do? Well, don't do anything. Alerts happen all the time. Or call your customer to see if they can explain. Speak to your money laundering reporting officer, or tip off the press.
Certainly not option number 4 might happen from time to time, but I thought. Well, I mean, certainly doing nothing is probably not an option. I think an alert is an alert, and so you should react to it. Calling the customer, I would have thought those sneaky customers that are laundering their money, they're going to have some sort of explanation, aren't they? And that's probably not going to get you very far by calling them to see if they can
explain. You don't want to get prosecuted for tipping off either.
No, absolutely. So the MLRO, as the acronym went earlier in the course, has got to be the chap that you need to
tip off the press.
Let's have a look. There we go. So we're all
if
pretty
in
much
doubt, you need to speak to your money laundering reporting officer, I think. Let's go with that then. Here we go. It would be a bad idea to alert your customer to your suspicions. There you are. And then there's a summary. And there's one final section on terrorism, which is everybody needs to be aware of the Terrorism Act and how they launder money. The Terrorism Act 2000, there are offences under money laundering, fundraising, arranging funding, and using and possessing money or property. And you must report them if you have any suspicions, because failure to do so can result in a prison sentence. There's some information about information gathering. Anti-money laundering stops terrorism, so perform those customer due diligence checks. And doing international business, assess what the risk is. There are some signs of terrorist financing that you must be aware of. And a case study here about a charity sending funds to Turkey and then money being withdrawn in Syria. So one final quiz, guys. A transaction between parties crosses business sectors and national boundaries without any clear business reason. Is it cause to be suspicious? Yeah. It is suspicious, or no, it's harmless.
Well, Sounds suspicious to me, Ellie.
I reckon we need to be alert.
We've got, I think if I share these results, I think we've
There
got
we
a
go.
fairly clear indication from what the audience thinks as well.
And what we've learned is that if individuals, if we're in the relevant sectors, if we don't report something we think is suspicious, we could be liable, personally liable.
Absolutely.
So be aware. So guys, that's our new money laundering course. If you want some further information, there we are, there's the answer. No, it was incorrect. Yes, it was suspicious. So if you want some further information, as always, you can contact us here at WorkRite. We'll always give you access to the course and take you through it some more. There's then a summary, and then your staff will take a test to prove that they've understood that training that you've given them. I'm really proud of this course. I think it's really good, and it's interesting to do.
Absolutely. Well, particularly the names of our suspicious individuals certainly keep it interesting for me.
We're
So.
getting a bit cheeky with this course. There we go. Thanks, as always, thanks for listening, guys.